Before we begin this podcast, we'd like to remind listeners that Netwealth is licensed to provide general financial product advice only, and that this podcast isn't tailored to any particular person's objectives, financial situation, or needs. Before a listener acts on any advice in this podcast, they need to think about whether it's appropriate for their circumstances or their clients, and consider the product disclosure statement for any proposed investment, and also seek any professional advice they need. Netwealth Investments Limited is the issuer of Netwealth's financial products. For Netwealth's financial services guide, contact details, and other information about our products and services, you can visit our website at netwealth.com.au. Today's podcast guest is a financial product issuer. Netwealth and the guest have a commercial arrangement that enables investment in products managed by the guest through Netwealth's platform. Under that arrangement, Netwealth may receive fees from the podcast guest. More information about the fees Netwealth receives is provided in our financial services guide, which is available on our website or by contacting us. Welcome to the Netwealth Portfolio Construction Podcast, brought to you by the Netwealth Investment Research Team. In this podcast series, we pick the brains of key wealth management professionals to uncover opportunities and challenges for investors on a diverse range of topics. We hope you enjoy their unique perspectives.
Welcome to the Netwealth Portfolio Construction Podcast series. My name is Paul O'Connor, and I'm Head of Investment Management and Research for Netwealth Investments. My role at Netwealth is to manage and govern the investments that we make available to you, our investors, and also to look after the investment products that we issue in the market through managed funds and managed accounts. Today we have Michelle Lopez, Head of Australian Equities for Aberdeen Standard Investments. Good afternoon, Michelle.
Good afternoon. Thank you for having me.
Pleasure to have you here, Michelle. Aberdeen Standard have a number of different Australian equities funds that are available on our superannuation and our non-superannuation platform, covering large, mid and small cap strategies. So I guess, Michelle, you're probably the most qualified person at Aberdeen to talk about the Australian equities strategies that are available to our listeners. I thought today we'd focus on a few global macroeconomic thoughts that Aberdeen and Michelle might have, but then we'll drill down specifically to small cap stocks and I guess the market and the portfolio that Aberdeen Standard have available. So starting at a macroeconomic level, many commentators are saying that we are late economic cycle and that GDP growth is certainly moderating and corporate earnings weakening. What are your thoughts on where we're at in the economic cycle?
It's a very timely question, and when you're investing in a market, you really need to think about cycles and how we're placed for that. If we take a step back and we consider what we've been through in the last 10 years, every asset class has gone one way, and that's up. So I can't refute that call. What we need to start looking at now is more and bring it back to the fundamentals of companies. So the uplift that we've had from very cheap capital and debt in our markets, the valuation uplift that we've seen across a number of different asset classes, and specifically the equity market, has been driven by, yes, a lot of earnings growth coming through. That is now that top line, and the growth trajectory of the top line for us is coming back. So when we consider our investments, we can't just rely on the cyclical upswing that we're going to get. We now have to look at and spend a lot more time on what's going to drive the businesses themselves on a standalone basis. And that's what I mean by bringing it back to the fundamentals.
No, I can appreciate the comments there about the economic cycle and that fundamentals are the focus ultimately in the valuation of the business. Turning our attention to the ASX, we're seeing weakening property prices and, do you believe they're going to have a knock-on effect on the Australian banks? And really, I guess, what's your view on the Australian banks? And in your active portfolios, have you got an underweight or an overweight position?
Okay, so first and foremost, the tightening credit conditions that we've seen play out over the last 12 months have certainly impacted the banks. We've just been through the banking reporting season, so all the majors, with the exception of CBA, have reported, and there's been a clear contraction in credit growth. The expectation, and our expectation, is certainly for that credit growth to continue to be benign over the next 12 months. We do not see what the catalyst will be, with the exception of APRA. So APRA today, and I'm not sure if you've seen the announcement, they're looking to pretty much give banks a lot more autonomy around setting the minimum interest rate floor. So to put this into context, at the moment, APRA has set 7.25% as the minimum as a serviceability floor. Going forward, the banks will be able to lend to 2.5% above their lending rate. So if it's at 3.5%, they can go up to 6% roughly. So again, this creates a bit of a trigger in the market and something investors need to be mindful of. It could, together with a number of other macroprudential tools that could be used, stimulate this part of the market again. Specific to your question around being underweight banks, yes, we have been underweight banks for a number of years now. And we probably got this call, we're a bit too early to this one, but we went underweight back in 2014. And it did cost us a little bit for the first year or two of holding that position, but we have more than made the outperformance over the last couple of years and what's happened with the banks since then. We saw a number of things and it didn't exactly play out as we had thought, but the concepts were there. So firstly, the stretched nature of the consumer and the serviceability of the consumer we were starting to get quite concerned with. And then obviously the property and residential property specifically, we're getting to levels and valuations, we're getting to levels that looked to be quite frothy. So again, we thought that given the exposure to residential mortgages within the major banks, it was a real risk to be holding an active position in those banks. If I can perhaps take a bit of a sidestep though, and given what we've seen with APRA, there's a real understanding that the health of the housing sector is maintained, and given, to your point, the implications it has to the underlying consumer.
Yeah, well, I would imagine that's very valid in terms of that would be the focus of the RBA as well, trying to keep price stability in the residential property market and making sure that there is no contagion knock-on effect. But interesting your comments there around slowing, or very benign credit growth, because I think we are seeing that in the Australian market across most of the underlying industries. Turning to the federal election, I guess the results of last Saturday certainly surprised most people in the Australian market. And positively, the ASX had a really strong return yesterday, so it clearly viewed the return of the incumbent Liberal National Party as a positive. What are your thoughts on the re-election of the Liberal National Party and the impact on the market that could potentially have?
Sure. Absolutely. I mean, the behaviour that we saw yesterday is a very clear indication of a tail risk that we had over the economy now abating. So when we, under a coalition, the return of policy status quo is likely to calm the anxiety in sectors that were going to be impacted from the proposed changes that Labor had foreshadowed. So looking at the sectors in isolation, so clearly the banks had a significant rally yesterday. I think they were up close to, some of them, 7%. And really the removal of any further bank levy that was mooted by the Labor government. We're also expecting more measured responses to the Royal Commission and no changes to the negative gearing. And that was a big one for the banks and what that meant to our point earlier around credit growth and what that meant for that part of the market. So that's the first sector that's clearly benefiting. Private health insurance. That was another sector, again, that had quite negative implications under Labor. So under a Labor Party, it was clear that they wanted to impose a 2% pricing cap over the next 2 years. And a number of the players in this market have really delved down into their business models and were already factoring that in. So what we saw from the miracle election result was a number of these private health insurers, the likes of Medibank, NIB, they had a big relief rally yesterday, again, because this I guess, cloud is no longer certainly going ahead, although our view is that 2-3% around there is probably the way forward for this market, and given the pressure that we've seen. The other part is, of course, the dividend-paying blue chip stocks, the banks, the miners. These are companies that pay out quite hefty dividends, and now the risk around the franking credits no longer being eliminated. Again, that's given them a big uplift.
No, we certainly, negative gearing and the impact on property and residential property and franking credits were probably two of the major influences in the election result, I think, from what occurred last Saturday. Moving on to small cap stocks. Perhaps, Michelle, can you explain to the listener firstly what are small cap stocks and what really makes this sector attractive to investors?
Sure. It's interesting when I get asked what part of the market represents the best opportunities. It's always a difficult question to answer given, my role is to find opportunities across the entire market. So I always reframe the question as to what part of the market offers more opportunities for active returns. And we call this alpha potential. There's a number of research papers written on this, and we started looking at it from a cross-sectional volatility perspective. So if we looked at the ASX 300, the X20, which is the mid-cap, and the small caps, and we measured cross-sectional volatility back till 2004, what we found is that, just to take us at what is cross-sectional volatility, it's whether stocks move together or they're divergent.
Across the different market capitalisation.
Correct,
bands.
Yes. And these studies showed that the greater the volatility, the greater the cross-sectional volatility, the greater the opportunity to generate that alpha and add stock picking skills really come to the foreshore. So with this in mind, the opportunity that I see within small caps is very much at its core that the market this part of the market is much less efficient. So efficient from a point of the information available on the stocks in this part, in the small cap market. And I'd like to just put a bit of context around this. So if we think about Altium, Altium's the largest small cap at the moment within the index. And I look at the number of research houses or people that are researching, studying, analysing this company. There's only 5. I compare that to a BHP. There are 34 analysts researching that company. And to your point, when it comes to insight and the idiosyncratic risk that we see within the small cap space, that's really where an investor can add value. From an opportunity point of view, there's also a realisation and a misconception that small caps are higher risk and lower quality. And that may be the case from a generalisation point of view, but really when you delve into it, you'll find some excellent small cap companies that have got great management teams, industry-leading positions, and really strong balance sheets that can execute on the strategy that they've got in place. So I get quite excited getting out there and kicking a lot of tyres in this part of the market. We've been able to find some gems there, and you can see that through the type of returns that our small cap fund has consistently been able to generate.
Yeah, interesting, I guess, and particularly relevant, your comment there around Altius being covered by, 5 investors in Australia ultimately, whereas I think of a stock like a BHP, almost every Australian would have a view on BHP and the outlook for iron ore. So I can understand your comment around small caps being less efficient than the larger cap section of the market there. And also interesting your comment around risk as well. And I think as an industry, investment professionals, we can get caught up with defining risk around volatility. And yet I think risk can mean many different things to people. But ultimately, I think to most of us as investors, it's about generating a return over an appropriate time frame that we set ourselves. So moving now into the Aberdeen Standard Small Cap Fund, what sets you guys apart from the other small cap managers in the marketplace?
Sure. Good question. And I always talk to three distinct factors. The first one is our core focus on fundamental research. So to the point I mentioned earlier, this part of the market is an under-researched part. We have a very robust and detailed research and analysis that's delivered insights that have very much exploited these inefficiencies that we talk to. They've led to very high conviction calls. So we currently own 37 stocks in the small cap fund, which is very high conviction, and the portfolios look very different to the index. So that's the first. The second one is our relentless focus on quality and governance and understanding the downside risks of our investment. So what this has led to is a very low downside capture, but we've also participated on the upside. So if you look at the risk return metrics for this fund, it's quite impressive. And then the final point here is, and really what is unique, very unique to Aberdeen Standard for the Aussie small caps, is our global network of investors. So post the merger, we now have 180 equity investors around the world, and that has been invaluable in tapping the ground, so on the ground resources and research. So we've got local people who understand not only the language spoken in a number of these countries, whether it be Thailand, Japan, Mexico, but also the cultural nuances. And it's interesting because we've got a number of Australian small cap companies that are either offshore, so selling offshore. A number of their operations are offshore, manufacturing. So being able to be nimble and get this insight from the ground up has been quite material in the calls that we've made.
Before we bring you the second part of this chat, a little bit about who we are. Netwealth is an ASX-listed company established to help Australians take control of their financial futures. With a wide range of super and investment accounts, a huge variety of investment options and market-leading online tools, we can help you manage your wealth your way. Partner with us to see wealth differently and discover a brighter future. Visit the Netwealth website to learn more and get the PDS, which you should read before making a decision. Products issued by Netwealth Investments Limited.
Yeah, interesting there. And I guess, one of the comments that resonates particularly is around your comment around quality. And I find in the small cap space, because to manage the risk, I think one of the key parts of a good investment manager is someone who understands quality and can really define quality. Moving on then, when you're actually identifying a quality stock, what are you looking for? What are these attributes that we've been talking to?
Sure. It's funny because quality is a term that is so obvious in our industry, and it gets, flown around quite materially. So for us, we are incredibly clear around what quality means, and we break it up into four broad buckets. So if I can start with the first, ownership structure. So we look for companies that have got very clean company structures, visible earnings, and consistent cash flow conversion. So that's the first. The second one's the business strategy. Very important to understand the industry that the business is operating in. So we look for attractive industry characteristics such as barriers to entry, market share, and the trajectory of the market share is very important. We look for a very clear strategy to execute within the industry and a sustainable competitive advantage. The third point is management. So we spend an inordinate amount of time meeting face-to-face with the management teams of the companies that we're invested in. And this happens at least every 6 months. And by management, I mean the CEO, CFO, Chief Technology Officer, but also the managers below that who aren't as polished and perhaps can give us a bit more of an insight as to how the culture really feeds through the organisation. And we do this because the execution is so important. The experience of the management team is very important in the track record, especially if we go into markets that are a bit more turbulent. You need to have a very steady pair of hands navigating through this. And the other important thing to note is that they need to be fit for purpose. So a small cap company, which a founder has run from the beginning, is very different to what's required for a company that's perhaps in turnaround mode or is in defence mode or attack. So understanding the skill set required for that company at that point in time is important. The fourth point is the financials. So again, we spend a lot of time looking through the financial accounts, the balance sheet, income statements, cash flow statements to see if there's any funnies in there. And we've been able to avoid all the blow-ups that we've seen in this part of the market. So, whether it's in the mining services space or the lithium space or, the aged care, and we've managed to avoid all of those. And a good reason for this is a lot of offshore balance sheet liabilities. We always bring those back onshore. We like to see consistency and clarity and transparency of cash flows and the conversion of that from earnings. So again, looking at some very tangible things. And then the final one, which again, to your point, something that we do quite differently, is our focus on stewardship and ESG. So ESG is at the core of our analysis for every company. We are engaging on a constant basis with not just the chairman, but independent non-executive directors of the boards. And particularly in the small cap space, we feel that if there's proper governance introduced within their business, then that's really setting them up for future success.
Yeah, I guess, we do hear the term ESG or environment, sustainability, governance bandied around a lot in the market, but I also do find that there are a number of managers that live and breathe it in the way they actually look at a corporate and whether the corporate will have a sustainable business model. And I think a lot of that does play back to the ESG factors there, Michelle. So thank you. From an overall portfolio perspective, would you say that the positioning is defensive? And can you get a more defensive positioning in a small cap type portfolio?
It's one of the interesting characteristics of our fund is the downside capture. So what I mean by downside capture, if you look at, let's take the last 5 years, and every month that the market was down, we captured about 45% of that. So it's a very low downside capture. So to your point about being defensively placed, I'm not sure if it's defensive, but that strong quality focus really shines through when markets...
So what you're saying there, sorry, Michelle, is that when the market has a loss or small cap sector produces negative returns, you're producing smaller negative returns than the market.
And in some case, positive returns.
And in some case, positive.
Correct. And the other side of it, which is very important for small caps as well, you don't want to miss all the upside. So the upside capture over a 5-year period is 80%. So again, we're absolutely participating in that upside. And we've had periods so that we've outperformed in a material way, even when markets are going up. The thing to note and the thing to be very clear around is the outcomes that we've been able to produce are very consistent. And with a return back to fundamentally driven markets, which we expect will be the case, rather than strong momentum, this is the type of portfolio that tends to outperform in those type of markets.
Can you perhaps provide a few examples about recent trades in the portfolio, what you've bought, what you've sold?
Sure. I mean, one of our, I often get asked, what's our largest high conviction call? And when I look at the portfolio, one of the big ones, and it's been a core holding for us for a number of years, is ARB, Corp. I'm not sure if you're familiar with ARB.
Yes, we are, the Melbourne-based company.
Correct, yes. So ARB, which do four-wheel drive componentries, they are based here. They also have a large manufacturing facility over in Thailand. And what we've seen with ARB is a company that has consistently and conservatively grown over the years. The management team is very conservative from the point of view that they've had to come back to the market to raise equity since the IPO. And they are now a formidable player offshore. So a lot of the growth to date has very much been domestically driven. However, if we look out for the next 3-5 years, a lot of the growth that this company will be generating is offshore. So the likes of the Middle East, Asia, and the US market, which are significantly larger markets than what the Australian market is.
And they have close relationships with the car manufacturers as well,
Absolutely.
don't they? So
They
they're
do.
sort of playing a very niche role in
They do, and this
the
is the
products
other.
they offer.
Yes, absolutely. The other interesting part about ARB is their manufacturing facilities over in Thailand. Yes, they've got a cost advantage. They've also got a time advantage in the sense of where they're positioned is right next to some of these auto manufacturers, such as your Fords and whatnot over in Thailand. And the area the area that they're situated is called the Detroit of the East. So again, they've got a time advantage compared to a number of their domestic peers here. And it's no surprise, that a domestic market share is close to 50%, and it's such a niche part of the market. However, offshore, there's a huge opportunity for them if they're able to execute on that. And when we look at the industry structure, when we look at the management team, the balance sheet, this is a company that really ticks all those quality boxes. And then finally, from a governance, the one thing that I have found over the years is many of these small caps, which are still run by the founders and have been very successful, there's a bit of a friction for them to introduce governance frameworks that perhaps they're not used to. ARB is a tricky one, so the founder still is involved, although they have stepped aside from ongoing daily operations and have put in a very clear succession plan to bring the managers in. They're also open to discussions around skilling up the board for their offshore growth opportunities. So again, for us, it's not just a black and white call around governance. It's, are they willing, and is the trajectory moving in the right direction?
Oh, interesting. And thanks for that stock example there, Michelle. And finally, maybe for our listeners, have you got maybe one or two investment rules, personal investment rules you've developed over your lifetime? You've had a long, career in investment management, but maybe even something going back to your teenage years or at university that has stuck by you, I guess, since then, and something that might provide the listeners with some good insight.
Sure. That's a very good question. What are the two things? First and foremost, compounding is your friend. So, understanding that $10,000 invested today, if invested in a high-quality portfolio of assets, can be incredibly valuable, taking that 10-year view. So compounding is your friend. The second one is, and I've been burnt with this one, don't ignore the cycle. Don't bet against the cycle. And it's interesting what we've seen over the years, and probably more timely, these tech names that have done incredibly well. If you had taken a position to short that given valuation, when momentum's been behind it, when there's some global thematics really pushing these stocks along, it would have hurt quite materially. So again, just be mindful of the cycle. And the third one is do your homework.
Do your homework.
Do your homework.
Yeah, I can understand. That certainly resonates there. But I can't recall, but I do remember someone referring to compound interest as the seventh wonder of the world. So
there you go.
Yeah. So thank you very much, Michelle, for joining us today for the Net Wealth Investment or Portfolio Construction podcast series. We've very much appreciated your time and your insights there. Listeners, thank you for joining us for today's podcast series, and we look forward to joining you on the next series.
Thanks for listening to this episode of the Net Wealth Portfolio Construction Podcast Series. For more episodes and to subscribe to our series, visit our website www.netwealth.com.au or visit the iTunes Store or Spotify. We hope you can tune into our next episode.